My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video tutorial, we're just going to give you a couple of additional examples of working with discounted cash flow analysis in the context of leases. So if you've been having a little bit of trouble still understanding exactly what you need to do with determining cash flows and discounted present value in the context of leases, then you'll want to follow along in this video. Okay, so here's our first problem. We have an asset that has a fair market value of $4 million, a useful life of 4 years, interest rate per year is 10%, payments per year are 1, in other words we're making just simply 1 payment per year, and the payments are to be made at the end of the year, and our lease term is 4 years. So the question here, what's missing is, what is our lease payment? What's the dollar amount of our lease payments? Well, it's not just simply $4 million divided by 4, so it's not just simply $1 million a year, because that would not incorporate the concept of a rate of return for the lessor, nor would it incorporate the cost of capital for the lessee. So what we need to do here is calculate the payments. That's what's missing. In some problems, we know what the payments are, and we have to determine what the present value of those payments are going to be. Here, we're missing the payments, and we are going to compute the payments assuming that the present value will be exactly equal to the fair market value. In other words, $4 million. So, what you need to do is make sure that you get your calculator set up correctly. The present value of the analysis is $4 million, and what you're going to be looking for is the dollar amount of the payment. This is kind of a little bit more from the perspective of the lessor, because they have an asset that's worth $4 million. They want to receive cash flows such that they get a 10% rate of return. And so they'll be interested in figuring out what those payments should be. So what I want you to do here is hit the pause button, work on your calculator, see if you can determine what the payments are. Once you've done that, come back and we'll explain what's happened. Okay, so hopefully you have worked through this, and I've brought my Texas Instrument calculator up here. And so I'm going to go through the same process, same sequence of steps that we've been doing in class. This should be now becoming somewhat automatic for you working with these discounted cash flow analyses. You should be getting pretty adept at this. So the first thing I'm going to do is hit the second or shift key, clear out the time value of money, hit the shift key, make sure that my payments per year is set up correctly, which it is not at the moment. So I hit 1 and enter or set. So my payments per year is now equal to 1. And payments are at the end of the year. And so I do not have the BGN or begin anywhere in my calculator window. So payments are occurring at the end of the year or at the end of the period. That's the default set for the calculator. If you need to change that, you have to go into the menu path. It's Shift and then Begin, and then it's Second Set, Second Set, and you can toggle back and forth between beginning of the period payments and end of the period payments. So we want to make sure that this is end, so just make sure end is showing in the window, hit the clear button a couple of times, and I'm good to go. So now what you should have done is taken $4 million as our present value. 10% is our interest rate per year. 4 is our N, number of payments that are going to be made. And here I compute the payment. And so the payments are going to be $1,261,883. So that should be what you got on this particular problem, $1,261,833. So now we're going to revise the problem a little bit. And so the next version of the problem is, notice that everything's the same except now that payments are made at the beginning of the period. So you're going to go through the exact same set of sequence of steps, except now you have to determine the present value of the payments, or you have to determine what the payments will be if payments are being made at the beginning of the period rather than at the end of the period. Once again, hit the pause button, see if you can work this out on your calculator, and come back and I'll demonstrate the solution. Okay, so I'm going to start over here again, clear out my time value of money, make sure that my payments per year is correct, which it is, and then I have to change my calculator setup to recognize beginning of the period payments. So I want BGN, or begin, showing in the window. And so now I can go through the same thing that I did before. I've got a $4 million present value. The interest rate is 10%. I'm going to be making 4 payments, and I compute the payment, and we can see that the payments here are going to be $1,147,167. So hopefully that's what you got when you did this particular problem. All right, going to continue on to the next exercise. Once again, some of the issues or some of the terms have been changed here. Now our payments are going to be made twice a year and made at the beginning of the period. And so now let's see if you can work your way through this particular example as well. Hit the pause button once you think you have an answer for the amount of each of the payments. Then we'll come back and I'll demonstrate that for you. Okay, so I'm going to go through this again, clear out the time value of money. Payments per year now are 2, so I have to make sure I get that set up correctly. Beginning of the period, I've already got that set up. So now once again, my fair market value, or the present value of the assets I'm receiving, is $4 million. Interest rate per year is 10%. And my number of periods is 8. And now you probably just said to yourself, whoa, hold on, why is n equal to 8? Well, remember, the lease term here is specified as 4 years, but I'm making 2 payments per year. That means that I have a number of payments, or number of periods, of 8. And so now I can compute the payments, compute payment, and we'll see that payments of $589,416 each will have a discounted present value exactly equal to $4 million. Okay, so we have one more example here, and so now we've got a fair market value of $4 million. Payments are back to 1 time a year, made at the beginning, but now the payments are $1 million. So what we want to do in this particular problem is determine the present value of the cash flows. The previous versions of the exercise, we didn't know what the payment was. What we had was the assumed present value that the lessor wanted to receive. Now what we have is the actual dollar amount of the payment, and we need to determine the present value of that payment. Once again, hit pause, see if you can determine the present value of this cash flow, and come back and we'll demonstrate it for you again. Okay, so I'm going to clear out the time value of money. Payments per year should be set up as 1. My calculator is already set up for beginning of the period payments. And so now my payments are $1 million. And I'm going to insert that as a negative cash flow, $1 million cash outflow. I'm going to be making 4 payments. discount rate is 10%, and here I compute the present value. And we can see that the present value of a series of 4 $1 million payments, each made at the beginning of a period, discounted at 10%, present value is going to be just under $3.5 million. And by the way, in the context of a lease, this would not meet the 90% criteria. 3.5 million out of 4 million. If we just divide this by 4 million and multiply it by 100, we can see that that's only 87% of the fair market value. If this were a lease contract, it would certainly meet the 75% criteria of useful life. 4 years out of 4 years is obviously 100%. All right, so that's just a little bit of a tutorial working on dealing with these discounted cash flow analyses in a variety of situations, and hopefully you found this useful and beneficial.